let's create a case study then. So
Yeah.
let's create the scenario where you have an individual that has now, they're in a place where they're unable to continue to make payments on all of their debt. And we've got less than 30 days to make a decision. Typically, what most will do is they let the credit cards go first in terms of late fees. They're going to keep paying their card payment, keep paying their mortgage payment, their rent payment. We start getting into the needs, right? What needs to get paid first, and then what
Right.
gets paid last typically are credit cards, student loans, medical bills, personal loans, those things. So let's say we have someone in that situation where there are tons of people. I work with a good amount of folks that are really at that brink where they've got little to no cash flow, or they're operating out of a negative and essentially borrowing from their utilization, credit cards, lines of credits, to pretty much finance debt. And they've got a run rate that's running out. Out of the three options, debt consolidation, debt settlement, debt restructuring, where does your head typically start with someone that is at that place? Zero to very little cash flow to negative cash flow. We're about to be late on something. Say we got very, very little time, 30 days ish, or less, to figure out what our next move is going to be. Where does your mind typically go first?
First thing I'm going to ask them is, you know, do you have the time and ability to increase your income in any way, shape, or form? Can you get a
Well, that's first.
part-time job?
Yeah.
Can you,
Can we
what can
make
we do to
fast money?
increase
Can we
income?
get a gig? Right.
Yeah,
Anything
right.
to almost
What can we
buy
do? A
30
side
more
hustle.
days. Mm-hmm.
Yeah. Number one, what can you liquidate? What other assets do you
What
have
can I
that you can
sell?
get access to that you can
Garage
leverage?
sale. Okay.
Yeah,
Cool.
right.
Too.
Um, then from there, um, is how long can we continue in this with this situation, and how long is it going to take to pay off one card so that we can free up that cash flow, pay up the next card, free up that cash flow? If we're basically snowballing, how long is it going to take to for us to get out of this? Can we bite the bullet for 6 months or a year and tighten our belt and push through this, or are you pacing? Are you really? I mean, is it going to be
Yeah.
buying groceries? You
let's
know,
say let's say we're doing that, person did that, and then hurricane comes, tornado, natural disaster. Now they're like really down.
yeah,
Okay, it's down to like paying groceries or paying my credit card bills. So
yeah,
let's say we're at that point, right? We did first and the second. We've even exhausted friends and family, asking for help, church, you name it. Say we used
yeah.
that, and we're still behind, but we have decent to good credit because it hasn't tanked yet.
Okay,
We're able to maintain. We're able to maintain. Okay, we bought 30 days, Sebastian. We bought another 30 days, but I'm
yeah.
still behind. This hurricane just came through, took out some things. You know, work it. We're not in work right now. We're not working. Now what? What's our next play?
Okay. So if we have decent to good credit, because that's the next thing, is okay. What is our debt to income ratio? Because even if we have decent to good credit, if we don't have, if the DTI is lopsided, um, then we're not really going to be able to get any other tool to help us.
Correct. Lopsided meaning over 45, 50%,
For a better product, under 30%,
under
but
30%. Okay.
but you can get help with 40%
All right. Let's say we're there.
DTI.
Let's say we're
Yeah,
there, right? Because a lot of Americans are already there, even with positive cash flow. They're at like 30+% DTI. So let's push it to
hmm
40. We're around
okay,
40% DTI. Time's running short, but we
yeah,
have pretty good credit. We're in the
yeah. So it
high
would be worth an
6%.
application to see if we can get approved to consolidate.
So debt
Um,
consolidation.
yep,
That's
to
like the first
to
thing that comes to mind. Okay.
right, that at that point, right? Because then potentially we can take 3 or 4 debts. Let's say we're the monthly expense on that is $300-400. Maybe we can get that into a new product and cut that expense in half.
Yeah.
The interest rate long term may not be favorable, but short
into the
term,
payment.
it could free up cash flow.
Yeah, we're really focusing on the payment at this point
Correct.
that can free up the cash flow to buy you that time that you need to now keep doing the same thing of steps 1 and 2, gig, more income,
Correct.
tighten the belt, right? Cut, reduce, restrict,
Yeah.
temporary conservation mode to
Hmm.
really self-analyze every dollar that's coming into your economy and really maximizing every dollar that goes out. So, and to be very clear, because I've seen people say they did a debt consolidation, but what they actually did was more of like a debt settlement. So, debt consolidation in this example that we're sharing here doesn't involve you not making your payments on your debt. So, we're going to draw that distinction, that line in the
Right.
sand, is a debt consolidation does not involve you no longer making any payments on your existing debts. What will happen is a lender comes in and pays off things for you. And now you have a new lender. So you took out 6, 7, 10, 3 lenders to have just one lender, one account, one payment, one rate.
Right.
Okay.
Yep.
Let's say, because that's the simplest, most straightforward, and there's a lot of ways you can do debt consolidation, right? Maybe obtaining a
Right.
line of credit,
Right.
PLOC, HELOC,
Right.
first lien. There are even credit cards could somewhat
Hmm.
do it in a sense. 0% for 20, 24, 12 months, 18 months, that sort of thing. Or home equity loan or big jumbo loan, personal loan. And it's just eating up all those other debts. Now you got one
Yep.
payment. You would agree that's like probably one of the easiest, simplest ways to go about it
Right.
to sort of stabilize a family.
To stabilize. Right.
Yeah.
Another use case could be where you do have good credit, but maybe you're maxed out on your credit card and you do have good debt to income, right? And so your objective is to potentially get access to a line of credit at a lower rate, whether it be a HELOC or a personal line of credit, but you can't qualify because your utilization on your credit cards are so
Yeah.
high.
Mhm.
And then in that case, it might make sense to get a term loan that you can use to pay down the credit cards, not necessarily pay them off in full, but get them to under 30% DTI, not DTI, debt service. Um, so that way the balance to limit ratio is under 30%. And voila, your 680 credit score turns into a 780 credit score because now you have 10 credit cards that were over 50%, now under 30%. And that's something that a lot of people are confused about because when you look at the credit report, it shows you this overall utilization ratio.
Mhm.
But when it comes to credit cards, each individual credit card
Has
impacts
its
your
own.
credit score per card. So you can have 10 cards, 9 of them have a zero balance. One of them is over 50 and it's going to tank your score.
Yeah.
You get that one card under 30, your score goes up.
Yeah.
And so that's another case where it might make sense to get that loan, even if it's a term loan, not a line of credit, to as a bridge to pay down the credit cards, increase the score. So now you can qualify for the HELOC or the personal line of credit or business line of credit. And then you can practice velocity banking.
Right. So velocity banking typically being like the first preferable option from us, if it makes sense and if they understand it and if we can set it up properly, then great. If not, term loan is like the next option to almost buy time to get the next tool,
Right.
or a home equity loan if you have a property, or a big personal loan that just kind of like
Correct.
sums up all the debts. Okay, so now let's make it even worse and
Okay.
say where same person, they're doing steps 1 and 2 that you mentioned, but their DTI coming into this where 45, 50% or more DTI. So now
Yeah.
we're flipped. Now, what's the next thing that comes to mind? Even after doing everything you said,
Yeah.
externally getting, more income, spending less money,
Yeah.
all that stuff.
So no
Time's
more
running
options.
short. Yeah,
You can't
hurricane came
qualify for
through.
anything.
Right,
Yeah.
can't qualify for anything. You tried, we
Yeah.
applied, put the app in, didn't get anything.
Nothing. So that's when you're going to have to look at, uh, national debt relief. and compare that to a bankruptcy
Okay.
and decide which one is more suitable for you based on your circumstances. And again, with that type of company, national debt relief type of company, you are going to pay back the debt, not in full. You're going to pay them a fee. So there is going to be a repayment. The bankruptcy, there's going to be a cost of the attorney, which is probably going to be a lot less. So those are the variables. Then you have to look at 10 years on the bankruptcy, 7 years on the defaulting, and that you would get with one of those companies.
Yeah. So with a national debt relief, what they're instructing us to essentially do is to stop paying the debts that we're looking to get rid of in that
Yeah.
sense.
So
So
just so that we don't get in trouble, we're not attacking you,
no,
national debt
that's true.
relief.
That's true.
We're just yeah.
That's true. No, because there
We're
is a
just
world where
yeah,
it can make sense.
yeah, and it does help people, to rebuild over time. Um, but but in a case where, because if the company, whoever it is, can provide you with a solution without defaulting, that's advantageous. However, most of the time you will have to be in a default. You're already on the brink. You're probably going to default anyways.
Yeah.
What happened?
No, you're good. I was just putting you full screen.
Oh, oh, you're probably on the brink. You're gonna default anyways. And so at that point, they're just gonna step in and represent you, and you know take the burden off of you of having to talk to these institutions and deal with it. But again, there's a cost to that. They do have a cost, right? And it's just added on so you don't feel it because you're still paying less than what you would have paid back. So it makes it helps in the end.
Gotcha. Okay. I think that's really helpful. We're gonna have to do a part two to this for sure.